Thanks everyone for joining us today. I am Lauren Dempsey and I'm a realtor in the Denver area, and I'm lucky to be joined by Jess Uphoff, who is a top lender across the country and works a lot in the Denver area as well. We have a lot of clients that have lots of questions about how to get unstuck because they have really low mortgage rates, but their home no longer suits their lifestyle. So we have decided to put together this presentation to really dive into the strategy of how to become unstuck. And we want to uncover some interesting tidbits of the current economy and consumer situation that may surprise you and make you realize that your 3% rate may be holding you back. So with that, we're going to share a screen, dive right in, and get going. So the topic is Unstuck and Upgraded, navigating your home transition in today's market, which is definitely different and challenging, especially in the post-pandemic environment that we are facing. So we'll share a little bit about who Jess and I are. We'll talk about who you are as a consumer, what your challenges are, the economic landscape that we need to navigate within, as well as the real estate landscape. And we'll offer 5 different solutions for you to consider so you can identify what the best fit solution is for your unique situation. And then from there, we'll give you an offer of how to help you become unstuck. So with that, just a little bit about me. As I mentioned, my name is Lauren Dempsey, and I'm a realtor in the Denver area. I run a small team that is focused on professionalism and strategic advice for our clients who are looking to buy, sell, and invest in the Denver area and beyond. Prior to becoming a realtor, I was a graduate of the United States Naval Academy, and I was stationed in San Diego, where I drove warships, big and small. From there, I went to the Pentagon, where I led PR and communications for the Navy and advised some of the nation's most senior military leaders before deciding to get out of the Navy after 14 years and getting into real estate after a brief stint in the corporate world. I've been in real estate now for about 5 years. I've helped nearly 150 clients buy, sell, and invest, and have a small team, like I mentioned, that helps support us, help our clients build wealth through real estate.
Awesome. And I'm Jess Uphoff. I run a division of Jet Home Loans. It's called Concierge Home Loans. We are a local lender here in Denver, and we support many local real estate agents and builder partners with their business. We have a unique boutique style of lending where we're very consultative. We meet with our clients to help them kind of with some of the logistics of transitioning between homes. We help first-time home buyers. And a little bit about me, I'm a Colorado native. I have 2 young boys and a husband I've been married to for 15 years. I've been a lender for 20 years, and I proudly worked my way up the ranks to one of the top female originators in the country, which is very exciting. I love what I do. And one of my favorite things is partnering with people like Lauren to provide consultative logistical help for our clients to figure out how to do some things that are not quite as cut and dry, such as trying to transition between homes.
Yeah, I would say that Jess and we have similar mindsets. So we are focused on education and strategy. And one of the things that we specialize together as a lender realtor team is helping our clients transition between homes. So we're really excited to show our strategies to help you become unstuck. Yeah, the next. There we go. So who are you? You want to move, but don't even know where to start. Hint, that's what we're here for. Your home no longer suits your lifestyle. Interest rates have been, at this point in time when we're recording this in February of 2024, interest rates have been above 6% now for 19 months. And a lot of life has happened. Death, divorce, babies, college, all that type of stuff is big life transitions that mean that your current life and your current home may not suit you any longer, but you really don't want to lose that low interest rate that we may never see again. On top of that, we've all been impacted by inflation, and our savings is running low, our debt is running high, and interest rates are high on that short-term debt, and it's really creating a pinch for a lot of consumers. And they don't understand or may not recognize that the amount of equity that they have in their home presents an incredible opportunity to clear out debt and become unstuck and find a home that suits your lifestyle now and in the future. What are your challenges? Well, there are challenges as well, because the low interest rates that we saw during the pandemic have really created a lack of movement in the market. We saw it in 2023, where we had some of the lowest sales volume in decades. The reason being is people have that low mortgage rate that they really don't want to give up. 89% of people with mortgages actually have a rate below 6%, and 82% of consumers have a rate under 4%. So those are really incredible rates that you just won't be able to get today. And so a lot of life has happened. Like I mentioned, your home may no longer suit your lifestyle, and you're struggling and don't know whether it's time to remodel, or if is it just best to make a move, or do sit and suffer, which we hope you are not sitting and suffering. What we'll talk about a little bit is like, why would you even consider giving up your low rate? We're going to break down some of the finances that may open your eyes to opportunities. And then from there, how do you move? Transitioning between a home you own and a home you want to buy is actually very complicated, and there's a lot of logistics and planning that goes into it. And that's where Jess and I really break down the strategy and make it as seamless and as stress-free as possible.
All right, so this part of the sector, we're going to talk about what's going on economically. And one thing I'm going to focus on a little bit is for the consumers that are finding themselves, like Lauren said, with a significant amount of debt, because there are a lot of Americans that have debt right now. We just have come off of a very high inflationary cycle. American households have been pinched pretty dramatically. So if this doesn't apply to you, if you're not in a significant amount of debt, or you do not have debt at all, feel free to fast forward a little bit to where we start talking about the ways you can transition between homes. But if you're like some of us and you have more credit card debt or consumer debt, and you're interested to hear how your 3% or below 30-year fixed rate might be holding you back, do tune into this part, because it's pretty fascinating. So let's just talk about the economic landscape for consumers right now. Personal savings is at an all-time high. So if you see that gray bar in the top box there, that is the pandemic. That was the recession that we went through during the pandemic. And if you look right after that, we have a big spike in consumer savings. People were getting supplement money from the government for the pandemic. We were not allowed to travel. We couldn't eat out very easily. It was harder to spend money during those 2 years we were stuck in our houses. And so Americans were able to pay off a significant amount of debt and put a lot of money in savings. So we had an all-time high for consumer savings at the time. But then if you look at what's happened since there, as inflation went up, starting in 2022, we had a big spike in the cost of everything, the cost of goods and services. And so basically, as you see consumer savings dwindle down to its level in January of 2023, which is where this graph stops. But consumer savings is at an all-time low. And then credit card debt as a byproduct is at an all-time high. We just surpassed $1.2 trillion of credit card debt, which is a massive number as a country. And then people are sitting on large credit card balances with really high interest rates, because every time you hear that the Federal Reserve increased interest rates, they're actually increasing the federal funds rate, which has a direct correlation with your credit card payments. Every time federal funds rate gets increased or spiked by 1/4 or 3/4%, it has the exact increase on your credit card rate. So Americans are finding themselves in more debt than ever, with increasing interest rates on their credit cards, and it's becoming a big mound of debt to get out from under. But the good news is that Americans are sitting on a tremendous amount of equity. And so some of the things we're going to talk about tonight is, what can we do with this debt and our equity and still transition to a new home and upgrade to that new home? Lauren and I are going to show you the path of how you can successfully do it with the equity you have in your home. Okay, so I hear, as a mortgage lender, I hear so often people that want to make a move or they want to access equity in their home, but they are really, really fixated on this amazing interest rate that they secured during the pandemic. During the pandemic, from 2020 to the beginning of 2022, We had record low rates, the lowest I've ever seen in my entire career. So rates got as low as into the twos. I love how people brag to me like, I have a rate of 2.625, and it is one that would be hard to part with, but at what cost is what I would ask you. So this is actually this is a client of mine. What she owes on her house is $475,000. Her interest rate is 3.75, and her total PITI payment, principal, interest, tax, insurance, is $28.19. And Jane is her name, that's what we'll call her, wants to make a move. She's ready to transition to a different home. She needs more space. Her family is expanding and she's trying to figure out what to do. So I meet with Jane. We do a consultative pre-approval appointment, and part of that pre-approval appointment is doing an analysis of what Jane qualifies for. And that includes looking at what Jane's liabilities are. What does she have on her credit report that I have to consider in her overall qualification? Jane has 4 big credit cards, and these are Jane, they just got into some debt as a family, going through, again, inflation and the cost of goods and services going up. They just ended up supplementing with credit cards as a family. And so Jane's got 4 big credit cards. It's a little over $80,000 worth of debt, which is an extreme example, I would say, but this scales with other families. These are her true interest rates on her credit cards and her true minimum payment that Jane's paying monthly on the 4 credit cards. So when we look at her entire household interest percentage, her blended interest rate, which is her mortgage and her credit cards together, what she's holding in totality, she has a $556,000 outstanding amount of credit that she owes, or debt that she owes. Her total monthly payments on her mortgage and those 4 credit cards is $48.33 a month. And her blended interest rate total is 7.066%, which just so happens to be a smidge above where mortgage rates are today. So her blended rate is actually higher than where mortgage rates are. And so it is something that we have to consider as we think about maybe transitioning and helping Jane and her family get out from underneath this debt. The average American per CoreLogic has about $274,000 worth of equity, and that's the majority of Americans' wealth. So we need to look at how can we use Jane's equity to help her transition to a new home and be able to consolidate her debt and not extend them even more as a household. So they're barely getting by at the $48.33 a month. And so Jane would like to accomplish a few things. She'd like to lower her monthly payments. She would like to transition into a new home. And she'd like to hold on to her 3.75% interest rate. So I put together a presentation for Jane to show her exactly what this would look like for Jane to be able to transition to a new home.
Hey, Jess, before I let you share your screen, one thing I'll just point out too, I know that these are just credit cards, but this could easily be swapped out for 2 car loans. Car loans are very high right now. So the $85,000 is not necessarily unrealistic when we look outside of just credit card debt, but home equity lines of credit. I'm working with lots of clients today who are looking to sell, but also have their HELOCs all the way maxed out. So I know that number may sound high to some viewers, but when we look at overall debt and we break it down outside of just credit cards, Americans do have debt. And I think you and I see it intimately because of our job.
Thank you, Lauren. That's a really good point. So I'm going to pull up the presentation that I built for Jane. Jane identified that she wants to be in a different part of Denver. So her move up house isn't too much above what she owns now. So her current home, Lauren could sell her home for $700,000. This is her total payments. So if you look at Jane's current breakdown of her monthly payments, her all-in mortgage payment, again, is the $28.19. Then she's got the $2,014 a month of non-mortgage debt. That's what comprises her current household output of $48.33 for her payments. If we look at her new home purchase, so she's looking to get into a home that's a little bit more expensive. The home in the area that she wants to be is approaching $800,000. So what Jane and I put together is selling her current home, paying off the credit card payments that she has, that debt, so she can get out from underneath it, putting down the difference of her equity. And then we did a creative interest rate buy down for her just to get her interest rate down a little bit. And her all-in monthly payment is $4313.91. So she's upgrading to a new home that's slightly more expensive in a better area that's closer to her family. And she's saving about $520 a month in total payments. Now, the even cooler thing is, let's say that she was comfortable at $4,800 a month. Yes, it would be nice to save $519, but the other thing that we're all facing is we eventually want to be completely debt-free, right? We want to get 100% out of debt so that we can live mortgage-free and debt-free at some point in our lives. So I also put together for her just what it would look like if she just continued to pay what she's paying now on her $775,000 house. So if she was willing to contribute the $520 a month savings to aggressively pay down her mortgage loan, what would that look like over time? So let's say Jane, we're going to look 15 years out, she's purchased this home and she made that additional $520 a month. If she did not pay that extra $520 a month towards her mortgage, 15 years from now, she would owe about $429,000 on her house. Yes, she'll refinance at some point, I'm sure, but let's just for the sake of looking at the data, let's pretend she didn't. She would owe $429 on her home. If she just simply paid for 15 years, the $520 that she was paying to credit card debt, she's now paying it towards her mortgage. Now her mortgage balance, 15 years, same time cycle, would be $274,673. So she just gained a couple $100,000 worth of additional equity just by making that transition, taking that extra money that she's saving and putting it towards putting herself in a better position for retirement. So overall, just to recap, Jane's upgrading to a new home. She's getting closer to her family. She has more space for her family, and she's able to get out of credit card debt and save more for retirement by paying her house off faster. So Jane's winning overall just through this strategy of being able to use her equity and accomplish all of her goals with the right strategy.
Yeah, I think this is such a powerful example, Jess, of why 3%, 4% rates for mortgages are actually holding many consumers back. And this is the type of strategy that Jess and I love to do, really identifying where the pain points are with our clients, and then diving into the financial situation and the options to help them achieve that freedom again and enjoy their life, enjoy their home, and get rid of that weight that debt is. So it's really a powerful example of the potential of how real estate helps our clients build wealth and the different strategies that are not mainstream, but can really help achieve a lot of savings. So with that, let me share the presentation again. So what is the real estate landscape? In 2023, we had just around 4 million homes sell across the entire country. I know that may seem like a lot of homes, but in the past, we've seen $6 million homes sold. So we saw a significant reduction in the amount of homes sell in 2023, and it actually matched numbers that we saw in the 90s. So a significant drop in sales. And this is just shows the cyclical nature of real estate here in the Denver metro area, but it's also similar across the country. And what it shows is just when the first half of the year, we see the amount of new listings go up. And then in the second half of the year, the amount of homes that hit the market go down. You can see the noticeable drop in the amount of listings and homes that were sold in the Denver metro area right here between 2022 and 2023. So that has presented some challenges in the market because people aren't putting their homes up for sale, and that creates pain points for a lot of consumers. One of the things that I think we've learned during these high interest rate period is that actually mortgage rate volatility, where rates jump up and down 0.5%, can create more fear and uncertainty with consumers than just elevated rates that are consistent. So our hope, and a lot of experts are talking about rates going down. We obviously can't bet on that because there's always surprises, and we're not in control of the economy as much as we would like to think we are. But I think just understanding that rates are in the 2s, 3s, and 4s are not typical is important context to understand as you look to your future real estate purchases. One of the things that is an interesting phenomena, a lot of people are talking about the market crashing once rates went up, but inventory is really the key to what is going on. I always like to share this slide with my home buyers because it goes back all the way to 2010 in the Denver metro area. And at that time, at the peak of the housing crash, we had somewhere between 25 to 35,000 homes for sale, 8 months of inventory, buyers had options, and prices went down. But as a result of the cause of the mortgage crash, builders stopped building and inventory really got chipped away at quite a bit over the past decade. Here during the pandemic, there were some neighborhoods where we were measuring inventory in hours. It was very low inventory across the entire metro area. And we've recovered. We have just over 2 months of inventory in the Denver area. It's still a strong seller's market. Nationally, we don't have a lot of homes for sale. We're talking about less than 1 million homes for sale for our entire country. So that is just important perspective to keep in mind as to why did prices stay high in spite of high interest rates. And it was because we have not had enough homes for sale, and that's what keeps prices elevated. So part of the challenge too is we talk with a lot of baby boomers, and they all want to move. They are sitting on tons of equity. They have the most real estate wealth of any generation ever. But they don't have anywhere to move to because that inventory is not available. So baby boomers' homes that would be typically available for first-time home buyers aren't necessarily hitting the market as much. So we're really in this crunch period where people of all ages and generations do feel stuck. And that's our goal here, is to help you become unstuck. One of the interesting things that has happened, however, over this time period is that we've seen builders get back into the game. And especially last year in the Denver metro area, 18.4% of all sales were actually new build homes. So builders are building. And one of the reasons why buyers really like working with new build homes is obviously it's turnkey, move-in ready, modern design. But builders can offer some really great financing incentives to offset the higher rates that we're seeing. So we do think that new builds will continue to be a dominant force in the market, and the more inventory we can get is better for everyone.
Okay, so the solution, what is the solution? How do we successfully transition in a low inventory, higher interest rate environment? We have a bunch of equity and we want to upgrade to a new home. What does that look like? Well, Lauren and I have identified 5 ways to do it. And we're going to go through the pros and cons of all 5 tonight so that you guys can have a good understanding of the logistics behind them. So I'm going to just name them real quick and then we'll go one by one. So the first way to move between homes or transition between homes is to offer on your next house contingent on the sale of your current home. The second way is to do a double move. The third way is to sell your home completely and negotiate a lease back agreement, or to stay in your current home as a tenant. The fourth way is to purchase your next home non-contingent on the sale of your home with something called a bridge loan, which we'll talk about. And then the fifth and final way, that's not for everybody, but is a good consideration, would be to retain your current home and hold on to it as a rental.
So what is a contingency? As Jess mentioned, contingency means that you as a potential home buyer can only purchase your next home if you sell your home before closing on the new home. So it is a lot of moving parts. Some of the things that buyers who elect to go as the contingent buyers, they like it because they know exactly what their home is going to sell for. They know what their equity is that they can tap into to apply to the next home purchase. And it means that you're not overextending yourself. Back in the pandemic days, that you had a good idea of what your home would sell for. We're not necessarily in that market anymore. And so pricing is really critical, and the market does move week by week, especially as interest rates go up and down. It impacts buyer demand. So understanding what your home sells for is certainly a pro when you want to buy a contingent. The fact is, though, that contingencies are more expensive and they can carry some risk that we'll dive into. Essentially, a seller doesn't always have to accept your offer as a contingency. So that in of itself can present a lot of stress and heartache because you're unable to get the home that you truly want for this next move. And a lot of sellers actually don't like contingencies, period. I was calling for one of my buyers this afternoon who was really excited about a home, and I talked to the listing agent and I just posed, would your seller accept a contingency? And they were like, no, absolutely not. We're not doing a home sale contingency. So there is resistance in the market for a home seller to accept a contingent offer. And if you think about it from the seller's perspective, that presents a lot of risk to them. They ultimately want to sell their home, move on to the next chapter, and want to have confidence that they can do that by working with just one party. When they accept a contingent offer, they're working with two parties. They're working with you as the buyer of their home, but then they also, through you, have to navigate the situation with the buyer of your home. So it presents a lot of moving parts and dynamic. And if you are unable to get your home under contract, let's say a seller does accept your home as a contingency, if you're unable to sell and get your home under contract within a certain period of time, you will lose the home and you'll lose the money that you've invested in doing due diligence on that home, from the inspection to potentially the appraisal. So there is risk in there. Jess, do you have anything to add on contingencies?
Yeah, I mean, I like to talk about the expense, because I think sometimes buyers take for granted, how is it more expensive? And quite frankly, when you're contingent, because sellers are hesitant to take on a contingency, as Lauren mentioned, but if they are, let's say they just don't have a lot of offers, they've been on the market for a while and there's only one offer and it's contingent, they do have leverage over the buyer. If they are willing to take a contingency, they are going to be able to negotiate better terms for the seller than if the buyer was non-contingent. In other words, if the buyer was able to remove the contingency and find a different plan to transition, they would be able to negotiate better terms for themselves with that seller. So it is something that impacts your financial output as well with the new home.
Yeah, no, I love those points because it's hard to negotiate on price when you have a contingency on the table.
Yep.
So we like to break this down into the different categories that our clients like to consider. And we thought that this visuals would be helpful for you to consider as you're looking through all these different options. As we mentioned, there is that cost involved, the cost of the due diligence, inspection, appraisal. There is fees and the lack of ability to negotiate as strongly as you would if you were a non-contingent buyer. Stress, I would say, is probably off the chart for a lot of these clients who elect to go contingent. They can't necessarily control when there's going to be a buyer for their home, what's going to be found on their home, and is that buyer going to terminate on their home, which would force them to terminate on their dream home. So there's a lot of moving parts and a lot of closely watching deadlines as part of a contingent offer. And then, like I mentioned earlier, the likelihood of getting an offer accepted with a contingency is not high here in Denver and across the country just because of our low inventory market. A seller would rather wait probably a few days or weeks to see if they can get a non-contingent buyer than necessarily accept your offer as a contingent buyer. So your offer acceptance is much lower. Anything else to add, Jess?
Yeah, the only thing else I was going to say is, even if, what was I going to say? I'm sorry, Lauren, I lost my train of thought. Oh, a lot of people I talk to are like, their number one challenge is, I want to move. I'd love to move. Like, this is wonderful that I am pre-approved to move, but I can't find anything. So much to what Lauren was saying earlier, that we have such limited amount of inventory. the number one challenge that buyers are up against is that there's nothing on the market. So when something pops up on the market, a lot of people are going to go after that same house because they want to live in Arvada, as an example, and they want mountain views and they want to be next to a park. Like, I just had a client lose out to 23 offers from an offer this weekend, which is a very extreme case. But it is an example that when a nice house in a nice area that backs to open space does pop up, it is highly competitive. And if you're highly competitive, like, the opportunity to get a contingency is zero. So really it limits you to be able to only buy a house that's been sitting on the market for a while that other buyers didn't put offers on. So I would say that the amount of homes that this would even be possible for is limited. And those are houses that have been on the market for a while.
Yeah, I think the timeline could be much longer than it necessarily has to be if you don't have that contingency too. And if you're thinking about upgrading, you want to find the right home that you're going to be in for the next 10, 20, 30 years. So giving yourself the best opportunity to find and win that home, contingency really is a challenge in our market, unfortunately. So let's talk about the double move. One of what you can do if you don't want to be a contingent buyer is move twice. And what we mean by that is you sell your current home, maybe you go find an Airbnb for the interim as you continue shopping so you can write non-contingent offers, or you go live in your parents' basement, which we do have clients do to make sure that they can be as competitive as possible. The great thing about this is that you're not pressured by any timeline at all. You're going at your own pace, and you are able to submit non-contingent offers. But obviously the cons are you may not want to pay for that more expensive interim housing, and you may not want to put your belongings into storage or a pod for extended periods of time. What happens if you have kids and pets? Like, there's a lot of moving dynamics there that finding a space to meet your lifestyle needs may be challenging or maybe more expensive than you want to pay for a short-term solution. And it is expensive. Like we mentioned, it's cumbersome. Moving is stressful. Moving twice is even more stressful. And it's not an ideal situation, but the great thing about it is it does remove that contingency.
I meet with a lot of clients who are like, oh, I could live in my family's house for a short period of time, which is great. I mean, I think there are people that this is the solution. So it's not for everybody. Like, if your family relies on having your separate space away from family, finding interim housing can be more difficult and, like Lauren said, expensive, but it is a good solution. So if people are like, I have family locally nearby and this is our solution, then get your house completely sold. The challenge is you cannot even start looking for a new house until you have your equity in your bank account, you have handed off the keys to the new buyer, and now you can actually physically start driving around with Lauren and start looking at property.
So let's take a look at the costs. Like we mentioned, if you aren't lucky enough to have family who let you live with them for a period of time, you are going to be looking at moving expenses twice, storage for your personal items that aren't going to be going to the interim housing, and then just if you don't have family, paying for that interim housing too. So there is a cost there. But I would also say there's a unique cost that the sooner you sell your home, you're not necessarily capitalizing on the market movement and the increase in prices. So you are leaving some potential money on your sale on the table to open up your ability to purchase. Not the end of the world. I always tell my clients that you can't sell high and buy low at the same time. So if you can sell in the middle, buy in the middle, you're coming out on top. So some costs there. The stress of interim living situations can also weigh on people. I was talking to a client who's looking to move out of state. They have 3 boys under 7, plus a dog and a cat, and talking about living with some older family. So from that alone, having 3 little boys running around a grandparent's home can be stressful for the grandparents and the kids and everyone involved. But the positive thing about a double move is you remove that contingency and you open up all the types of homes. And not only that, you have the cash and the funds, you know what your home sold for, and you can make smart financial decisions with your purchase too. Anything to add, Jess?
Nope, I think we can move on to the next one.
Awesome. So let's talk about a lease back agreement. When you are a home seller, you can actually sell your home and continue to live in it for up to 60 days. So you essentially become a renter in the home you used to own. And this is more common. It happens quite a bit in the market. It helps offset that contingent purchase. So it opens up more opportunities. You know what your home's going to sell for. And the challenge, though, is that not every buyer can support your desire to live in your home for additional 60 days. Maybe they have a lease that they need to get out of. Maybe their kids need to start school. So having a requirement to be able to rent back your home for 60 days after it sells can actually limit your buyer pool. And that could mean that you don't sell for as much money either. And 60 days is a short period of time because you can be looking for a home while your home is under contract. Sometimes sellers will be more likely to accept a contingent offer if your home is under contract and past a certain phase in the under contract negotiations, primarily past inspection. So you can start, 2 weeks in to start looking at homes, but you still will need to write that contingent offer. And then, if you're working with a top lender like Jess, she can close very quickly. And that can mean that you essentially have maybe 60 days to find a home and get under contract, and then a very fast under contract period to buy that new home. So a lot of moving pieces there with the leaseback agreement, and it does limit your potential buyer pool on your home sale. What else you got, Jess?
Yeah, I was gonna say the same thing. Like if you get one offer on your house and it's a good offer, let's say you get a full price offer and you're thrilled, but they're moving in from out of state and they need a place to live. Now you're having to pivot to another. Like if this is your plan and it doesn't work out, what's your backup plan? Is it the double move? Is it, are we gonna do one of the other options? So this is a good plan, but because it is such a short window, and the reason you can only do 60 days max is from a lending perspective. The loan agencies actually, there's a guideline that says if you call something your primary residence, you have to occupy that home within 60 days. And that's why it's not even really legal to do a leaseback agreement for longer than that. So it does put a lot of pressure on a buyer to try to purchase a new home when they're under this type of arrangement in a short window of time when we don't have a lot of inventory available for buyers.
Yeah. So the cost, it depends on your buyer, right? And the competitiveness on the sale. In the pandemic markets, buyers to win at your home, they were allowing you to live in it for free for 60 days. But now, today, if it's not a competitive situation, you're potentially going to have to pay that new buyer's first mortgage payment. And as we talked about, rates are higher, so that mortgage payment could be double what you're currently paying on your home. So not a horrible solution, but there is a cost there that could be more expensive than you were anticipating to allow so that you can actually stay in that home for those 2 months. The stress, again, on this one is quite high because you're limiting your time to find that forever home. So you are dependent on market conditions and sellers who are putting their home on the market to be able to find that forever home, especially I work with a lot of move-up buyers, and they tend to be much more thoughtful and intentional, and they take their time than necessarily first-time buyers because they know what they want, they know what they don't like in their current home, and they're really trying to find a home that fits their lifestyle now and in the future. The good thing about the leaseback is once your home has sold or you're past all of the contingencies in your home sale, the offer acceptance is much higher because you don't have that contingency. You've become unleashed in the market and you can make really strong offers with the funds that you know that you're going to net on the sale of your home. Anything else, Jess, on this one?
Yeah, the last thing, so January to May is generally like our highest demand for real estate season. And so I think the likelihood of getting a leaseback agreement is the highest between January and May. So if you're looking to sell your home and over the summer and the fall, you might have a lower probability of being able to find a buyer willing to do a leaseback agreement. In the first 5 months of the year, it's a little easier to negotiate.
So let's talk about bridge loans. And this is the ability to tap into that home equity that you currently have. Remember, Jess said it's about $274,000 average of home equity that Americans have. So you're able to tap into that money, leverage that money, and go write offers on a home that's non-contingent. So you're leveraging your current home to finance the purchase of your new home without having to find that buyer before you can go write offers. So it really is an incredible opportunity to write non-contingent offers. Most importantly, I think to take your time to get set up and pre-approved with Jess's team and to be able to deliberately and methodically evaluate homes and write an offer when you find the right home. The challenge, obviously, is that if you're tapping into hundreds of thousands of dollars of equity into your home and then buying a home that's more expensive than your current mortgage balance, you have to be able to qualify. So not every buyer can really use this option, unfortunately, because they may not have enough of a debt to income ratio to make those numbers work. And you don't know necessarily what your home is going to sell for, like we talked about. So we're depending on the market not changing or maybe only improving by the time you move into your new home and put your home on the market. So a little bit of a gamble from a net proceeds perspective. One of the things I love about this option as a home seller is I really believe it limits the interruptions in your home and allows us to market your home in its best light. And what I mean by that is that you're completely moved out of the house by the time we put your home on the market. So we've been able to do any updating that needs to be done. And then we're able to bring in staging that really is critical in our market to be able to maximize your sales price, because staging helps buyers draw that emotional connection to your home. So with a bridge loan, there is some cost involved to finance that bridge, but it really gives you as the homeowner the best opportunity to maximize your home sale proceeds, and then also the least amount of stress to be able to find that next purchase.
So when we say non-contingent, because this is what we're doing, right? Like a bridge loan is a solution to remove a contingency for a buyer. So if I have a house to sell, but I want to buy a new home and I don't want to be contingent, so I can be really competitive, I need to meet two right criteria. The first one is I have to qualify without selling my other home, as Lauren mentioned. And the second one is I need a down payment that's not coming from the sale of my home. So when we go non-contingent, we have to meet both of those criteria. So when we meet with our clients to strategize which of these options is best for them, I always like to look at both. And I'm willing to do that with my clients in the form of a strategy call. So before we do a loan application and upload a lot of documents, a lot of people just want to know, could this be a solution? Because they're in their house. They know that the area of town that they want to move to is highly competitive. They know the houses in those areas go really quickly. And so we want to identify what is your equity position? What is your ability to qualify with both? And we get pretty creative. So for example, I work with a lot of clients that are on a fixed income, like retired folks that are like, well, I don't have a ton of income coming in monthly, but we have other ways to utilize someone that has a substantial amount of assets. So I wouldn't self-diagnose that you can't qualify contingent. I would definitely lean on someone like myself, a professional that specializes in looking at the holistic picture of your finances to say, how could we potentially put the puzzle together to make it work? And the intention is to never own two houses at the same time. Like that makes everyone uncomfortable to like own their new home and not have sold their old house. And a lot of people don't like the idea of that. But what I would say is Lauren and I were so good as a team. When we write the offer on the new house, we are taking into consideration days on market in your neighborhood to ensure that we don't have you owning two houses for very long. I do a tremendous amount of these transactions. I would say about 60 per year. And knock on wood, I've never had one client making double payments on two houses at the same time. And the reason for that is strategic planning between myself and my real estate partner on behalf of our client to ensure that we set them up to be successful.
Awesome. This is why your team and who you work with matters so much, because there's obviously a lot involved. With there is a cost, like we mentioned, in the ability to get that bridge loan. It's essentially a third in-term loan that there is some fees there, but it's manageable, right? If it wasn't manageable, it wouldn't be an option or a product that is out there for you as a consumer. There is some stress, right? So there's the unknown of what your home is actually going to sell for once you've purchased your new home. And you have to move fast. So to be able to prevent double payments, you need to be packing, doing repairs, allowing my team and I to get in there and make sure that the home is going to be as show ready as possible, and get our marketing, staging, cleaners in there right away once you move, so that we can time it as seamlessly as possible to prevent any double payments. The great thing about the bridge loan is it removes that offer contingency. So your likelihood of winning the home is really great, and you have tons of equity in your existing home that you're able to tap into to make your offer even stronger as a buyer, especially in a competitive situation. Anything else to add?
Yeah, with the average American having $274,000 worth of equity, you're going to be making a substantial down payment on your new home. And there's ways that we can right size your mortgage. So for example, I'll just use round numbers. Let's say you're buying a $700,000 house and you have $400,000 worth of equity. We can't tap into all 400,000 in the form of a bridge loan. Let's say we can only tap into 250. Maybe we buy the house at 700,000. We put the $250,000 down. So now you have a mortgage that's a little larger than you wanted initially. However, right after Lauren sells your house, you're going to walk out of that closing from the sale of your home with a check in hand. We'll take that check and we can actually right size your mortgage in the form of something called a recast, where we basically apply a one-time principal payment to your mortgage and recalibrate your mortgage payment to get you exactly where you wanted to be before you had to go through these steps of being able to sell in these conditions. So I personally am a huge fan of the bridge loan option. The number one reason, and I've watched this happen time and time again for folks, is that because there's not a lot of inventory that's popping up on the market, when the perfect house pops up, you want to be competitive, and you also want to stay in your current home rather unscathed by all the things that we've been talking about logistically. So this just provides convenience, because you just stay in your home and just keep going about your life without having to completely overhaul your life to move. You get pre-approved this way with a bridge loan with Lauren and myself. And then we say, okay, let's wait for that perfect house to pop up. When the perfect house pops up, you call Lauren, you have her show it to you, and we plan and formulate a really strong non-contingent offer. We can actually close with a bridge loan in 10 days, which is really unbelievable to be able to pull off that kind of logistics. But on a house that has 5 offers, you might need that really fast-paced closing in order to win over the seller's affection. So just because you have a bridge loan scenario doesn't mean that you're going to be a less competitive buyer. You actually can be a stronger, more competitive buyer because you have a significant amount of equity and you can close fast. So this is my number one strategy for the clients that have the capability to qualify and have the equity position that they need to pull off the strategy.
Awesome. Yeah, I love bridge loans. It really helps simplify the process. I think what we've talked about, there's a lot of moving parts, and however we can simplify it, make it as stress-free as possible is always our goal. And that's where we believe the bridge loan, if you qualify, is one of the best options for you to get unstuck and get upgraded.
And before we move on, Lauren, I'm so sorry. I want to say one more thing. So on your new house, if Lauren and I were writing an offer for a new client today, maybe we would close around, the first week of March. We're sitting here in mid-February. Maybe we would close the first week of March. Your new mortgage payment isn't due until April. So if we get you under contract on a new home, you're closing at the beginning of March, your first mortgage payment, is not due until May. May 15th is when your mortgage payment's due. So basically, Lauren has from now, mid-February, when we get you under contract, until mid-May before you're going to have overlapping mortgage payments. And I think that's the number one objection that I hear to this whole structure of doing this bridge loan plan is I don't want to have more than one mortgage payment because my family can't afford two, as an example. But I think, again, if you work with the right team and they help you structure the whole strategy to avoid overlapping mortgage payments, 100% it's possible to do.
Yeah, and I think, if there is that fear of a potential overlap of payments, we could always hold back some of your proceeds from your sale to help cover some costs too. So just something to understand as we navigate how to do get upgraded. So let's talk a little bit about the retain and rent. So one of the best ways to build a real estate portfolio is actually to buy a primary residence, live in it for 2 years, and then go buy another primary residence and turn that previous one into a rental. So this is something that a lot of my clients are actually doing. I did the math in the past year alone. I've sent 8+ clients to my property manager. Those are people who were thinking about potentially selling or wanted to upgrade, and they wanted to keep their home, and they were able to make it work from a financial perspective to be able to do that. And I love that because I think it's just an incredible option to continue to diversify your portfolio and build wealth through real estate, which is a proven way to build that wealth is by owning multiple homes. So the great thing about it, again, is allows you to take your time with your purchase. So you're likely a non-contingent buyer and you aren't depending on the sale of your home to be able to purchase the next one. So you get to keep that appreciating asset. And in many cases, the people who are able to keep these homes, they've had some really great rates. So they're actually netting money, positive cash flow every month with their rental. The con is that sometimes, Jess can talk about this more, but you need to be able to show a lease on your existing home in order to qualify for the purchase. This happened to some of our clients last year, and it was quite a stressful experience because everything was going great for the mortgage piece, but we needed those lease in hand and that security deposit deposited in order to be able to get that final loan approval. And it was really down to like the last couple of days for my clients who were able to get their properties rented. So from that point alone, it can present some additional challenges if you need to have a lease in place in order to qualify. I do have personally, and Jess has rentals as well. They aren't free, right? The tenants need things break. We have to have property managers. I personally have property managers for all of my properties. I don't want to manage them. So there's a cost of that. So it's not a completely free option. You may have to spend some money. And if you can't rent your home for your all-in mortgage payment, then you also just kind of need to keep that in mind as well. And there is a certain level of risk. I always tell my clients if they are about to rent out their property, there's 2 things you need to understand. 1, the tenant is not going to love your home as much as you do, and there is going to be wear and tear on the property. And then 2, if you do decide to work with a property manager, property management in general is more of a volume-based business, so they need more clients to be able to make the financials work. When you're working with me and my team and Jess, you're used to a hands-on, personal, relationship-focused business, and we get to know one another. And it can be a quite jarring experience for a lot of my clients to go from the type of service and communication that we have from the sales perspective to go to the black and white perspective of property management. So that is just a non-tangible experience that I do get some feedback from my clients after they start working with property managers just in general. There's some really great ones, and I found one that I'm happy to share, but it is a very different experience than a sales experience can be. Anything to add on this, Jess?
Yeah, just a couple things from a lending perspective. So when Lauren and I meet with our clients and we go through these strategies, one of the things I love to show even seasoned home owners is just forecasted appreciation and historical appreciation data. And I always like to do an analysis for people that are considering retaining their home, because if you add up the value of the property that you currently own plus the value of the home that your prospective home, And you look at the totality of that amount of value together, and then you do the math, like the analytics of, okay, historical appreciation in Denver County, as an example, for the last decade has been 7% year over year for a decade. And that appreciation, because we have a limited amount of inventory, is likely to continue. It's forecasted to be about 5.5%. So if we take, okay, you're going to own, you have a house that's worth 7, you want to buy a house that's worth 9, we add those together, you know, you have $1.6 million worth of real estate, and you own them for 5 years at 1.5%, you know, or 5.5% appreciation year over year. It is a ton of money that you can earn, which is why people should consider it as an option. Having a 3% interest rate or lower on your house provides this unique opportunity that you'll never have to refinance that rate. Once you move out, you don't have to redo your loan. You get to retain that primary rate that you had. So let's say your current mortgage payment's nice and low for your $700,000 house, it's $2,800 a month. And you're moving into this new house and you're looking at a much more expensive mortgage payment. However, the consideration that I like to show people is, well, yeah, well, what will your current house rent for? Oh, it'll rent for $4,000 or $4,500. You know what I mean? That is a budget of money that now helps with affordability on the next house, because you now have an income stream coming into your household that you didn't have before. So if your new house payment is $5,000 or $5,500, it's a little bit above where you want to be. Now you have this budget of additional capital coming at you monthly, which is super helpful. The other consideration, to Lauren's point about the lending logistics, not everybody has to count the rental income to qualify. So we tend to try to avoid having to have a lease in order to qualify, because it just creates another logistical, you know, consideration to make as you're in the middle of the transaction. So if we don't need it to qualify, we tend to avoid having to collect that. But if we need it to help you upgrade to the next house, the way that it works is we would find your new home, get you under contract, and then we would turn right around and start working on pretty immediately finding your tenant. And you do have to provide a fully executed lease between you and your tenant, and then some proof of security deposits or first month's rent collected. We can walk you through that process, but just because you have considerations that you are concerns that you may not qualify, having that rental income from your exit home is wildly substantial in helping you qualify for your new house.
Yeah, retaining and renting, I think this is a test I guess you could have if you are interviewing agents and lenders. If an agent, the first thing they tell you is to sell your home, then my question would be, are they looking out for you and your best interest? Or if they just want another sale? So that is one of the first things that I share with my clients is, like, if they tell me when they want to sell, we go down this path to identify whether or not selling makes most sense and if they can keep it. And as I mentioned, those 8+ clients that I sent in the past year are 8+ sales that I personally did not have, but I know it's in the best interest of my clients to keep that home and build wealth through real estate. And that's what's really great about Jess and I kind of partnering through this, is to be able to give you that strategy call to dive into and make sure that this is not an option you're taking off the table because you don't think it's manageable. It's pretty complex, I'll be honest. So retaining and renting is really a different topic that we'll get into in a different webinar in a few weeks on March 5th at 6 p.m. We're going to just dive into this topic even more to answer all of the questions that arise. But just real quickly, you know, there is some costs involved with retaining and rent. You may have to run some background checks on potential tenants. And, you know, if you can't find a tenant in time, you do need that lease, you may have to terminate the loan or ask for an extension with the seller to be able to qualify for the purchase. So some costs, it's not prohibitive. The stress is only high, I would say, if you do have to have that lease in place to be able to qualify. Otherwise, the stress is more probably self-induced because you want to get a tenant in as fast as possible in order to not have those double payments and to have that rental income coming in. And the offer acceptance is pretty high unless you do need that lease in place. It can impact your ability to get an offer accepted, but working with Jess and her team, we can navigate that together. And one of the things I always share is that if you are in this situation, please consider working with a property manager because they know how to get your property rented quickly. And it's one less thing for you as a buyer to have to navigate tenant showings, doing background checks, all of that. So anything to add on this piece, Jess?
No, I'm looking forward to that webinar where we're going to deep dive into, the why behind it and how we've helped clients build wealth through real estate in retaining their exit home.
Awesome. So this was our fifth and final of the 5 different options for you as a homeowner who's looking to get unstuck and upgraded. We would love the opportunity to meet with you together as a team where I will review your real estate portfolio, kind of identify what I think your projected net proceeds would be. And then together, Jess and I will use that proceeds and she'll do an analysis on what potential options of these 5 could be best for you. We really believe in the power of working together, both from the real estate side and then the financing side, to give you a holistic overview of your portfolio and what your options are so that you can make an informed decision. So if you're interested in learning how to get upgraded and unstuck, we are here to help you and to help you just kind of identify what your options are and make it feel achievable. Yes, there's a lot of logistics and planning involved, but we specialize this and we know how to make it happen, which is why your team is so important. And if you decide to work with us on the buy and sell, and you are able to qualify for that bridge loan, we will pay for that for you. We will cover that cost as a thank you for choosing us as the team that you would like to work with. Anything else on that you want to add, Jess?
No, I mean, I think the cost is always a large consideration amongst consumers. And so I would say, if you are considering like, gosh, could this be possible for me to be able to transition between homes? I do think having the right team available to you and the bridge loan option of all 4 is the one that has the most convenience and logistical ease to you because you get to just stay in your home and wait for the right house to pop up. So I would definitely, if you're even, considering maybe making a move, definitely give Lauren and I the opportunity to at least do a strategy call with you and kind of chat through how it might all work. And then you can decide, is the bridge loan a good option for you and your family?
Awesome. And so the next steps, if this is of interest to you, please call us, text us, reach out. Here is our contact information. We are excited to help you get unstuck, get upgraded. Not only does it only help you, but it helps all of our other clients who are looking for your home. If you decide to sell it, we could use as much inventory as we can possibly get. And we hate hearing clients, the stories of clients that are in homes that no longer suit their lifestyle and are afraid to make these moves because they don't think it's possible. We love showing you the way to make it possible and are here to support you. So with that, any final words, Jess?
I don't think so. Thank you so much for watching our webinar, and we hope to see you in the next one.
Yeah, definitely. Thank you so much. Have a great evening.